Welcome to WCS Money Tutorials. Today's topic is how tapering by the Federal Reserve can hurt the stock market and cryptocurrencies. Nowadays, you see a lot of concern in the news about the Fed tapering because it can have a big impact on financial markets, including cryptocurrency markets. Central banks can have a tremendous effect on the stock market. This video examines how the Federal Reserve, otherwise known as the Fed, can change the prices of stocks, bonds, and cryptocurrencies. But these principles also apply to other central banks and other economies. Investors are worried about what the Fed will do because it can greatly affect the stock market, as can be seen in this graph. Without the Fed's emergency actions, the COVID-19 pandemic would have decimated the stock market, and it probably would have taken years for it to recover. This is why the stock market is so much higher, even though the underlying businesses are not doing that much better, and in many cases are doing worse. But this stimulus will soon end. Rising interest rates may depress stock prices, as can be seen in this graph covering mid-2018 to mid-2019. As the Fed increased the federal funds rate, the stock market declined during the latter half of 2018, even though the interest rate was still less than 2.3%. But the stock market recovered when the Fed indicated that it would not increase interest rates further. The Fed has helped the stock market by greatly increasing the money supply, by lowering interest rates to near zero, and by lowering long-term interest rates by buying long-term treasuries and mortgage-backed securities. Increasing the money supply and depressing the yields of bonds causes investors to search for higher yields by buying stocks and cryptocurrencies. This increases the demand for stocks and cryptocurrencies, which of course increases their prices. This is a major factor for the steep rise in the stock prices and cryptocurrencies in 2020 and 2021, but not the only factor. But alas, the Fed will eventually have to reverse itself, first by tapering, reducing its purchases of treasuries and mortgage-backed securities, then by increasing the federal funds rate, and finally by reducing the money supply. Tapering is the start of the reverse of this process, when the Fed reduces its purchases of bonds. To understand why tapering hurts investments, you must understand how supply and demand affects prices, and how those prices affect yields, and how yields change stock prices. Bond yields are usually calculated by dividing the total annual interest payment, which is usually fixed, by the price of the bond, which will vary with the market. If the price drops, then the yield will rise, since the total annual interest payment is being divided by a smaller denominator. The nominal yield equals the total annual interest payment divided by the par value, which is the amount that will be paid at maturity. However, when the bond is sold on the market, then its yield, called the current yield, may be higher or lower than the nominal yield, since the bond price will usually differ from the par value. The current yield is what an investor earns when a bond is purchased on the open market. The current yield equals the annual interest payment divided by the current market price of the bond. So if the bond price is less than the par value, which is the principal of the bond, and it is the value that the nominal yield is based on, then its yield will be higher than the nominal yield. So if a bond originally priced at $1,000 paid $60 in interest annually, but the current market price is $800, then its current yield would be 7.5%, which is obviously higher than the 6% nominal yield. As can be seen in this graph, longer-term bonds are more sensitive to changes in the interest rate. When the Fed tapers, the Fed buys fewer treasuries and mortgage-backed securities, which lowers demand and prices. Riskier securities will also drop in price because investors will buy safer treasuries and mortgage-backed securities rather than riskier securities, such as junk bonds. Investors will only buy riskier securities if their yield is high enough to justify the risk. Higher bond yields draw money away from the riskier stock market and cryptocurrencies into safer bonds. The Fed stimulus cannot be continued indefinitely, and it will soon end. The tapering will be followed by an increase in the federal funds rate, which increases short-term interest rates directly and long-term interest rates indirectly. Although rising interest rates are a negative factor for the stock market, it does not mean that the stock market will decline, since there are many factors influencing stock prices. But there will probably be an extended period of time during which the stock market moves sideways or declines somewhat. Of course, it could also crash, so trend carefully. Cryptocurrencies may also decline for the same reasons. People buy cryptocurrencies to speculate in prices, hoping to sell for more than what they paid. However, this is risky, so when bond yields rise, some people will sell their cryptocurrencies to buy safer bonds. This does not mean that cryptocurrencies will decline, although they may, but rising bond yields will have a depressing effect. Thank you very much for your time. If you liked my video, please subscribe. I would appreciate any suggestions, so please leave them in the comments below. Check out my website at thismatter.com for more than 850 in-depth fundamental tutorials on personal finance, investments, and economics. Check out my books on money at williamspalding.com. Thank you.